Talking about today, folks. Today we are talking about breaking the cycle. I run into this a lot, especially with my single family residence investors. They start off really great using private money lenders, and that's all good. You know, you get one guy to invest in your deal, and then that one guy, you know, gets a stated rate of return. Maybe you give them a deed of trust or mortgage. Maybe you give them, you know, some kind of security interest. Well, deed of trust or mortgage is a security interest in the property. Maybe you're giving them at a high interest rate, you know, so it doesn't matter how much the property makes. Maybe you're saying to your investors that you're going to return their money when the property sells, or you're going to make interest payments as you go along. I don't know what the case may be, but oftentimes what we see is that the issuer, yourself, the fundraiser, is getting themselves stuck into a rut. And what do I mean by that? You're constantly chasing money. It's this hamster wheel. And what do I mean by that? So, and I don't think there's a topic in private money that annoys me more than this particular topic. And why is that? Because I can see the frustration that using private money lenders can create. And I have this guy here on a hamster wheel running, chasing money, because that's basically what you're doing when you're using private money lenders, and you cannot deny it. I know any single one of you out there who's using private money lenders, this is your experience. You go out, you ask, you know, your neighbor, your friend, an experienced real estate investor, whoever it might be, hey, do you want to invest in my deal? It's, you know, it's going to take 3 months of rehab. Once I sell the property, I'm going to give you 10% on your money. Do you want to do that? Or I'm going to give you 12% or 15%, whatever it is that you're paying these private money lenders. And they say, sure. And then you sell the property and you return that investor's money along with the interest that you promised them. That's great. That's great for the investor. It's good for you. But what happens next? Then you go find another property. Then you have to do the same thing over and over again, where you have to go back to that investor and say, hey, do you want to invest in this deal now that I have this deal? And what does that investor sometimes say? They have to analyze the deal. They have to look at the deal. They have to figure out if they want to do it. So there's a time delay. Or worse, they say, oh, I already reinvested that money somewhere else and I no longer have it available. So we want to kind of stop this hamster wheel. The other thing that you're probably dealing with is that you're paying a bunch of different investors, different rates of return on different properties. You have, you know, if you have 20 properties, you have 20 sets of books, which you should have 20 sets of books for those properties, but now you have an investor attached to each one of those properties, and you're doing, you know, one deal per investor, or one investor per deal. And so that this investor over here is making 10%, this investor over here is making 9%, this investor's over here is making 12%. They're all getting paid different rates of return at different times. You have to have 20 different communications with 20 different investors at 20 different times with 20 different reports. That's a lot. And it's hard to manage. I actually, one of my early clients that I had, who was very successful with using private money lenders, he had this issue where he ended up having 100 different private money lenders on 100 different properties. And what ended up happening is he'd be doing books and records or communicating with investors until about 3 o'clock in the morning on some days, because that's what had to be done. Because an investor would ask a question and he would have to answer that question, and it would have to be specific to that investor and that investor's needs. And it becomes a bit much. The other thing we run into is that because you're doing this one investor per property secured by a deed of trust or mortgage, if you then end up taking in another investor into a deal, you end up stepping into securities laws. So what do I mean by that? If you've listened to any of my other webinars on private money lending and borrowing private money, you know that in many states, most states actually, there is an exemption from securities laws that allows you to have one investor per deal secured by a deed of trust or mortgage. And what the rule says is, it doesn't say you have to have one investor per deal. What it says is that you can have a note secured by a deed of trust or mortgage that is not fractionalized. In other words, there's only one investor. So that's what that not fractionalized means. Now, a lot of people have given me suggestions on how to get around this. The states know about all your tricks. They're on to you. Don't try tricks. The tricks don't work. So the only way you can use this exemption, and it's what's called a self-executing exemption, which means that you don't have to notify any state that you're using this exemption. You don't have to really follow any particular rules, except that one, you have one investor per property. It's secured by a deed of trust or mortgage, meaning you can't just use the note independently. You have to actually secure it against the property with the deed of trust or mortgage. And finally, you cannot advertise for any of those investors. So any of you that are out there on Facebook going, hey, I'm looking for a private money lender, and thinking that this self-executing exemption still applies, you are wrong. You cannot actually, under state rules, you cannot advertise for that investor. So that self-executing exemption, again, is limited to one investor per property that is secured by a deed of trust or mortgage, of which you used no general solicitation to get that investor. And you can see how this becomes this hamster wheel of a aggravation in terms of raising private money. And then what if you have a great investor and you need $100,000 and your great investor only has $75,000? Then what do? Then you're stuck. You don't do the deal. You have to come up with $25,000 of your own money. You can't go get it from another investor, because now you've entered into a world of securities. And now you have to do all kinds of other things. So are you going to do all kinds of other things just for one single family deal? Probably not. And what if you want to move on to other types of properties other than single family, such as buying a multifamily building? Multifamily is so hot right now, maybe a little too hot, but that's another topic for another webinar. Self-storage, mobile home parks. You're going to need more than one investor. A private money lender investor is just not going to cut it in that situation. So we got to change your ride, change it from the hamster wheel to a hamster car, right? So the first thing I want to have you do, which I've talked about in multiple other webinars. I know for a lot of you out there who watch these webinars regularly, you're thinking, oh, Jillian, you've already told us this before. I didn't get that. But it's so important, because the better acquainted you become with this, the better you can articulate it to an investor, which is why I hammer doing this all the time. You want to write down, and you only have to bullet point this: who, what, where, when, and how. You know, who you are, what you're going to be doing, where you're going to be doing it, when you're going to be doing it, all of these things. If you can just start answering these questions, you're going to be a better representative of your company, of your real estate entrepreneurship. And that's really what we want, because the better representative you are for yourself, the more confident your investors are going to feel about giving money to you. And I'll tell you, I've experienced this myself in my own business, where the more sure I was of what it was that I was doing and what I was doing, why I was doing it, who I was doing it for, it became a lot clearer to my clients as to what I could do for them. And it's the same for your investors. The clearer you get on what it is you do and who you are and what you're trying to accomplish and how you're going to use your investors' money, they start to see what's in it for them. So just like my clients see what's in it for them when I'm giving them a service, your investors are going to see what's in it for them when you're providing them a service. Okay. So hopefully you'll find that that useful. So what can you do once this webinar is over? You can take these points, the who, what, where, when, and how, and write them all down. And this is going to be a foundation for multiple things. It's not just going to be a foundation for investors. It's going to be a foundation for your website. It's going to be a foundation for content that you can be putting out there in the future. It can be a foundation for things that you can go out and research even further. There's a lot of reasons to do this for yourself. And honestly, this should take you no more than an hour to do. If you just make a commitment to yourself for tomorrow morning, first thing when you wake up is to do this exercise, you'll have it done. I promise you'll have it done. You don't have to write this big flowery business plan. You just have to get down a focused idea of who you are and what it is you're going to do. And that will help you with formulating what you should be doing next. So why, again, we're going back to that hamster wheel and trying to come off the hamster wheel. Why, again, do we want to come out off the hamster wheel? How will our life improve? Well, let's talk about my guy who had 100 investors on 100 different homes and was, answering investor inquiries and doing books and records at 3 o'clock in the morning. So we start getting our investors all on the same page, all in the same deals, pooling their money together, we are going to create an environment where they're going to be all treated equally, right? So in other words, this guy who comes in with $100,000 is treated the same as this guy who comes in with $100,000, the same as that woman who comes in with $150,000, as this woman who comes in with $75,000. They're all treated the same. They all come in, they all get the same distributions based on the amount of money they invest. They all get paid distributions at the same time. So distributions get paid at every quarter on the 15th, at the 15th day after the quarter ends. They all get the same distribution check. As a matter of fact, I just got a distribution check this morning from one of the funds that I'm invested in, my quarterly distribution check. And you know what? The sponsor of that particular fund sent out an email over the weekend saying, hey, this is what's going on with the company. Our distributions are scheduled to go out on this date. And so expect to see that in your email, a notification that we got something sent out. And if you have any questions, let us know. And here's what's going on with the company. And here are our expectations for the future. I got the same email that every other investor got. So instead of the sponsor, telling me, oh, here's what's going on with your individual property, I'm hearing what's going on with the entire fund. And we all share the same risk too, right? So individual investors on individual properties have different risks. So if you invest on 123 Main Street, you're not going to, and that's all you invest in as opposed to a single family fund, you're not going to share the same risk as the guy who, invests on 777 Lucky Avenue. I don't know where I got that street name, but there you go. I probably should have done like a musical reference, considering this is Private Money Rockstar. Like I should have said like 922 Abbey Road or something. Well, anyhow, you guys write in the chat box what your favorite rock and roll street is. So I'm prepared for the next webinar. Okay, so now we're spreading that risk. We're getting them all on the same timing. We're giving them all the same investments. We're giving them all the same distributions. We're making our life easier, but we're also mitigating the risk for our investors. Okay, so that's exactly just it right there, the pitch that you give to the investor. So I get this all the time. Jillian, my investors have been with me for a really long time. Not only have they been with me for a really long time, but this is what they're used to. They want 12%, secured by a deed of trust or mortgage. That's what they want. That's what they need. That's what they have to have. And I assure you, you're wrong. That is not what they need, and that's not what they have to have. And you have taught them that that's what they need and that's what they have to have. Another thing you've probably taught them is that they have to analyze every single deal, including single families. And that is simply not true. They're trusting you with their money, and they would be a quote unquote bad investor if you gave them all the due diligence for the property and told them to research it themselves, and then they didn't. So we're kind of setting ourselves up for these expectations ahead of time. I remember I used to invest with one company here in Southern California, and I did just this. I was a private money lender. I would give them, so much money, and then I would get a deed of trust or mortgage. And I always hated getting the deed of trust or mortgage because it actually represented work to me. Because if they did indeed fail, my recourse is I would have to go and foreclose and then take over the property and a whole thing. And quite frankly, I'm just not interested in doing that. I'm investing passively to do just that, invest passively. I'm not looking to foreclose. But another thing they would do for me is they would send me all of this financial information, all of this information on the property, et cetera, et cetera. And I felt obligated as a vigilant investor to research that property, make sure it was a good investment opportunity. I trusted them. I was putting my money with them because I trusted them, and I wanted them to go out and do the work. I knew where they were located. I had researched them. I knew what properties they were going into. And now they were dumping all of this additional information on me. And I felt obligated, in order to be a good investor, to go and continue to research. And they trained me to believe that that's what I was supposed to be doing. And I'm telling you right now, you're training your investors to do the same. So they're holding things up. They're holding things up for themselves. They're holding things up for you. Now, this is not to say that your investors should not be fully informed. That is not what I'm saying at all. I'm saying that you're teaching them that they deserve or should have a note secured by a deed of trust or mortgage. They should have a stated interest rate, and they should be doing thorough due diligence on every single family property that you purchase. And that is simply not true. So how do we get these people we've trained to believe those things from there to now a newly formed fund where you're flipping properties, buying and holding, whatever it might be? And so what we do is we tell them, look, we're going to diversify you amongst many properties. We're going to diversify you amongst many properties. Number one. So if 123 Main Street fails, they have not necessarily failed if they're in a fund situation where they have diversification, because they still have, 927 Abbey Road and what was the other one? 777 Lucky Avenue. And they have all of these other ones to support that 123 Main Street failure. So diversification, that's number one. Number two, no back and forth. I had mentioned on the hamster wheel that your investors are giving you money, right? They give you the money, and then the property sells, and you have to give the money back to them, and you have to do the whole thing over and over and over again. And that was the big thing for me that annoyed the living daylights out of me when I was doing private money lending, is that I would give the money to the company, and they would flip the money. Then I'd have to do my own little accounting for the flipping of the money, and then they'd bring it back. Then they would say, oh, we have another property. And guess what? I'd have to wire again. I'd have to go to the bank. This is back in the day when you can do wires online, but I'd have to go back to the bank. I'd have to do the whole thing all over again. It would have been just so much better if they just held on to the property and kept making it work, instead of making me fill out more paperwork and making me wire more money. I just want my money working for me. I don't want to make my money work for me. So that was the problem I had with the private money lending, is that instead I could put it in a fund and the money would continuously work, as opposed to making me work to make it work every single time. And also I had to make decisions. I had to make decisions about do I choose this property in San Diego County, or do I choose this property in LA County? Which one do I decide on? I only have limited funds. So that's, those are the things that we kind of have to think of. You don't have to make your investors make a choice. And so now I have this funny slide, and this is a picture of a wall in my house. And if you look in the middle there are 3 guitars that look exactly the same. And I don't know which one to choose from because they all look exactly the same. And I've asked my husband, why do we have 3 of the same guitars? He assures me that they're all very different. I don't know if I believe him, but I've also been told by him that you can never have too many guitars. So I don't know. Tell me in the chat box if you think you can have too many guitars. I think you can. Like, for example, I think this is too many guitars, but others may disagree. Okay, so let's talk about what do you need to do this. So if you go back and look at some of our other webinars, what do you need to do this? And yeah, there's a lot of ways. I'll tell you right now. Yeah, in a lot of ways, I'm telling you, you got to come to me so I can put this proper paperwork together for you. I also put paperwork together for people who are looking for private money lenders. I don't enjoy doing it. I know that I'm creating a hamster wheel for people. So I encourage people, don't get yourself on the hamster wheel, because you're just going to come back to me in a couple of years and we're going to put this together for you, which is a private placement memorandum. It tells the story of the investment. It says, hey, we're starting a single family fund. We're going to invest in single families in the following locations, and we're going to operate for 5 to 7 years, at which time we're going to dispose of all properties and return principal to all of the investors, or the capital contributions to all investors. In the meantime, we're going to pay a preferred return of 8%, and we're going to pay that quarterly, and then we're also going to pay a year-end distribution of 70-30, 70 to the investors, 30 to the management. The management's going to charge the following fees. And that's what we put into our private placement memorandum. That is also supported by usually a operating agreement. And the operating agreement is an agreement that says how an LLC, because typically we use an LLC for these types of deals, an LLC is going to run. And then we have a subscription agreement, and that's the agreement between you and the investor, that the investor says, hey, I am interested in investing. I've read your documents and I agree to the terms of your documents. And then we also have an investor questionnaire that asks the investor, who they are and what investing experience they have, or what income or net worth they have. And finally, we file Form Ds with the states and possibly SEC. And we sometimes also have to file what's called a U2 with some of those states. You don't need to know that so much as you need to know that when you're using an exemption under the law, and we have plenty of other webinars that cover that, you do need to file a Form D in the states where your investors are located within 15 days of your investors investing. Okay. So how can you do this? You can do this either through a syndication or a pool. And so a syndication is when we focus on one particular property. Obviously, if we're dealing with single family, which most of you who are dealing with private money lenders deal with single families. And so then a syndication wouldn't make much sense. We usually see syndications in bigger properties, multifamily, self-storage facilities, mobile home parks, things of that nature, or a pool. And where do we see pools? When we're buying notes and when we're buying single family residences. I also do pools for funds, like, for example, most of my public offerings, or actually all of my public offerings, are funds of some sort. So pools and funds are kind of intertwined in terms of meaning. And so all of my Regulation A offerings are funds. I have a lot of Regulation D offerings that are funds. And what do those funds say? The funds say, we're going to buy these types of properties. And that's what you would do with your single family too. The types of properties just happen to be single family properties. I do have some clients who combine asset classes into one fund. So they might say something like, we're going to buy multifamily properties and single family properties in these types of markets. Opportunity zone funds, for example, are usually a diversification amongst several asset classes, because it's really not about the asset class, but more about where the properties are located, which is, of course, in an opportunity zone. And we do have some other webinars regarding opportunity zones, so check out those if you would like. But it doesn't have to be about an opportunity zone. It can still be geographically, located or concentrated, and still be a fund without necessarily being an opportunity zone, without regard for asset class. So you don't need to identify the property, and what you can basically do is use this fund or pool as a line of credit as you need money to get this done. And I do have some ways of figuring out, well, because the next question I always have is like, well, if I'm using a line of credit, how do I figure out what I'm going to pay investors? And I do have some solutions to that. For those of you that are in Private Money Rockstar, the course itself, I have several different spreadsheets where you can work and figure this out. So if you're in Private Money Rockstar, the online course, please go there and download those spreadsheets for your use. I spent a lot of time creating them, so I want you to use them for their intended purposes of figuring this kind of stuff out. So, and you can figure out very easily what it is you should be offering your investors by using these spreadsheets. Okay. Now, another argument I always get, and I got to start taking questions soon, so I might cut myself short on these slides. The other question I always get is, what if I have an investor who invests more than anybody else? Or what if I have an investor who's arguing with me about how they don't want to change, they don't want to switch from this type of investment as a private money lender into the pool? So there's a couple of ways to deal with it. The number one way you can deal with it is jettison the investor. But if you're like, no, Jillian, I can't jettison that investor. They're so good. They're a great investor. They invest a lot of money. There's a couple of things we can do. We can add an incentive to invest more money, or we can add a time incentive so they invest faster. So I have a concept that I've created called the Magic Matrix. And what it is it basically puts together these different scenarios. Now, this is a very, I don't want to say it's a complicated scenario, but I don't necessarily recommend a scenario this complicated. If you make things too complicated for an investor, the more complicated you make it, the less likely they are to act or invest, because they can't make up their mind. They can't choose. Right here, I have, what do we have? 3 times 5. We have 15 choices. 15 choices of how an investor can invest. So we really don't want to give them 15 choices. Really what you should be doing is doing an either or situation. When you choose how you're going to do this, you should be choosing one way or the other. You should choose, I'm going to give them the opportunity to invest more money, or I'm going to give them the opportunity to earn more by investing faster, and not combine the two. What I have on the screen right now is combining the two. The more money you invest, the faster you invest it, the more money you're going to make. And really we want to do the more money you invest, the more money you're going to make, or the faster you invest, the more money you'll make. Not both of them. And here we've combined both of them. I don't necessarily recommend this because, again, I believe it creates investor confusion. And really the last thing we want to be doing is creating investor confusion, because a confused mind will not invest. I assure you of that. So, but you can do something like, hey, if you invest $100,000 or more, I'm going to give you a higher rate of return than somebody who invests $50,000 or more. If you invest $50,000 or more, I'm going to give you more money than somebody who invests $25,000 or more. So this is one way to do it. The other way you can do it is you can create different classes of shares, which is normally what we do. So for example, here we say investors who invest more than $100,000 receive Class A shares. Anybody who invests less than $100,000 will receive Class B. And then what do we give Class A as a motivation for investing more money? We might give them greater returns, more frequent payouts, or the ability to vote. Oftentimes in these private placement memorandums, we don't allow investors the opportunity to vote because we don't want to have to go to the investors for every little decision that you have to make in order to run the company effectively. You can offer a discount as well to certain investors. So for example, here we're offering a discount on shares. This was a share situation, and we just kept offering a little discount for the more money you invested on the purchase of shares. So now we've talked about the financial motivators, like the more money you invest. How do we do it as a time motivator? We are only offering up to $5 million in this. So we cap the entire offering. You better act now if you want to get in. Cap the time period. If you invest before the end of the year, then you'll make more money than somebody who is investing after the end of the year. Our preferred rate is going to turn. You can tie it to a specific index as well. Okay, so when can you do this? You can use them anytime. You just want to make sure you set it out in advance, that you don't change it in the middle of it, in the middle of the offering, unless it's to the advantage of the investors that are already in. So you can do it in debt, you can do it with equity, you can do it with a preferred return, and you can always use time motivators, so you don't need to have any kind of different financial thing or offering for that. You can say, if you invest today, I'm going to give you a greater rate of return than if you invest 2 months from now. Okay, so if you need some more information on the law, as always, you can get our helpful chart. If you don't already have it, just send an email with the subject line, helpful chart, to crowd@crowdfundinglawyers.net. It will send you this lovely chart. So if anything that I said about the law today was confusing, this chart will help clear up some of that confusion. But mostly I encourage you to go back and look at some of our other webinars that we've done before that will have more comprehensive information. In the meantime, get this chart, print it out, put it next to your desk, gaze at it, think of me fondly when you do. Okay, so some of you may or may not know, I have this great program. It's called Private Money Rockstar. It includes 6 weeks of training where I coach you. I say training, but it's really more than that, because I'm coaching you, and then you're going to go off and do things. I'm going to check it for you over the next 6 weeks. It's really super awesome. If you've been thinking for a while now, I really have to get up on my private money raising. I got to get some more confidence. I'm going to build your confidence. You're going to leave this 6 weeks feeling like I can raise money from anybody, anywhere, at any time. I can raise money for anything. And I really want to encourage you to join us tonight. We start tonight at 5 p.m. Pacific time. We do it on Zoom, just like you are here, but I also push it as a watch party on Facebook. So if you're driving in your car or something like that, you don't have to necessarily log into Zoom. You can just click on your Facebook and it will come up, and we'll be good to go. You'll be added to a private Facebook page. You'll be able to talk freely amongst a small group. It's a really small group. I'm not very good at selling this program. And I say that with all due sincerity, because I really don't want it to get too big. I had one group that was really, really big, and I felt like it was difficult to pay attention to every single person. So I've purposely kept this small, and I'm going to continue to purposely keep it small. I don't do a lot of 6-week programs. I probably do it 2 to 3 times a year. And that, again, is to keep it small, intimate, to be able to answer the questions and to be able to dedicate the time that is needed. So I really want to encourage you that if you want to do this, or you've been thinking about doing this, or kicking the tires on doing this and joining this program, join this one, because this is definitely the last one I'm doing before the end of the year. So if you want to get in on our 6 weeks, sign up at Private Money Rockstar. But wait, there's more. So what are you going to learn in Private Money Rockstar? Well, I'm going to, of course, teach you how to raise private money. I'm going to teach you where to find investors, how to talk to investors. I'm going to teach you how to do investor reporting and how to manage those investor expectations, which is so important. And then I'm also going to teach you how to market and advertise. The coaching itself mostly focuses on the marketing advertising. I have a bunch of stuff within the online course, which is run through a program called Kajabi, but we're going to be doing a lot of the marketing advertising on the 6 weeks of coaching as well. You can sign up at privatemoneyrockstar.com. I've left a lot of stuff out, which is that it comes with a bunch of templates, free questionnaires. I have some marketing templates in there. I have all those spreadsheets where you can figure out distributions and returns to investors in there as well. Each class, there's 6 courses in the course itself. Each course comes with not only a video, but then it also comes with a anywhere from a 15 to 30 page guide with not only similar information as the video, but additional information to the video. So the video, for those of you that are in the program, if you're watching the videos, awesome, but you're really going to get even more value over at reading those little guides that I wrote as well. I mean, there's just so much information in this whole entire course. And by the way, it's yours to keep. Like, and all of the PDFs, templates, things like that, they're downloadable, they're usable. They're not, it's not going to disappear after time. I have been making updates to the program. So if you're in the program, by the way, and you haven't been logged in for a while, please go back and log in, because I even made updates as late as this weekend. So definitely check that out when you get a chance. I also give you little quizzes. So you got to get your little graduation cap on when you're on there, because I do quiz you. The quizzes are easy and they're kind of fun. And I put cool pictures in the quizzes. Because that's what you want in your quiz is a cool picture. Okay, that's my sales pitch for Private Money Rockstar. We start tonight. I'm going to coach you for 6 weeks on how to raise private money. It's going to be private. You're going to ask me all the questions you want, and we're going to have lots of fun. We have a lot of fun in these meetings. I have some of the best memories are from doing these events with some of my previous classes, if you will. So let's and here's how you can get in contact with me. So again, go to privatemoneyrockstar.com to sign up for tonight's class. And now we're going to go to our questions. All right. Jillian, please be clear. Are you starting a pool of money yourself with all of us? Or are you asking us to individually create our own pool of investors? Oh, Paula, that's a great question. No. You're going to start your own pool of investors to invest in your own deals. I'm not starting a pool for you. That's a great idea when I'm not practicing law anymore. But for right now, I'm telling you, you want to start your own pool for your own deals. And then, go out and raise your own money. Now, one thing that we do here is, and I've been very fortunate to be able to do this, especially in recent history, is that we've developed a lot of relationships with private equity funds, hedge funds, and most recently, some family offices, where if I have a client who has a deal that makes sense for one of those contacts that I have, I will introduce my client to that contact, and then they can determine if they want to invest and have a relationship. But what I'm really encouraging you to do is to start your own fund. If you're out there using private money lenders and you're finding that it's becoming this hamster wheel of raising capital, get off the hamster wheel, get into a car and start driving. And the way you can do that is by starting your own fund, or moving on to bigger deals and doing a syndication. So Michael suggests that one of my street names be Highway to Health. That's a very good one. Clever, Michael. Very clever. Paula asks, do you get the investors to trust you because you have a limited partnership structure in place? I mean, that's just, no, I wouldn't say that's the way you get people to trust you. I would say you get people to trust you by becoming knowledgeable in what you are doing, and going out there and talking about what it is you do, being knowledgeable about your market, being knowledgeable about your asset class, and sharing that knowledge, becoming what's the word I'm looking for? I wish I could think of what the word is, becoming uninhibited, I suppose, in terms of what you're willing to share. I feel like I do that here, and I want to encourage you guys to do the same thing with your business. None of you are going to steal my amazing ideas about raising private capital, and if you do, good for you. Go out and steal away and share away and do that. And even if you do or do not offer me credit, but you have to think the same way when you're going out there and sharing ideas about real estate entrepreneurship and real estate investing. There's a difference between sharing information and being free with information and then coaching somebody, because I have no problem sharing information with you. It's when my time coaching you is what I want to be compensated for. And so what you want to do is your thought process should be, I'm going to share as much information I have about the subject as possible to gain trust amongst potential investors, and then go out there and say, now I'm going to offer you the opportunity. I'm going to offer you, the investor, the opportunity to invest with me, who is so knowledgeable about this very subject. And that's the kind of attitude you want to start putting forth. So what we need to know now is how to set up this massive fund. By the way, we should all be in Southeast Austin. Okay. All right. First of all, Paula, that's a great point. You don't need to have a massive fund. I've set up funds that were less than $1 million. It does not need to be a massive fund. You have to look at what assets you're looking at, the cost of those assets, the asset class, all kinds of different things, how many assets you can actually turn in a year. I don't want you to think that you have to start this massive $20 million fund. As a matter of fact, I can tell you right now that I oftentimes have people who come to me and say, hey, I want to do a $20 million fund. And I'll actually discourage them from doing a $20 million fund. I'll have them bring it down a whole lot, maybe like to $5 million, because we really want to analyze what it is that they want to do and how they want to do it and how they want to get out there. And what I mean by that is, here's the thing. If you have a $5 million fund and you oversubscribe by $1 million, so you raise $6 million, or you get commitments for $6 million from investors, that optically is so much better to investors than I have a $20 million fund and I only raised $6 million. Also, what if you can't spend all that money in the year? What if you have this wild success raising capital and then you don't have the assets to purchase, which is a problem right now. I see a lot of people having that problem right now where they just can't identify assets. So I don't want you to think like I'm encouraging you to start this huge fund. Quite the contrary. I'm just encouraging you to stop using private money lenders, because you're going to get yourself into this hamster wheel trap. I just want to avoid you from tiring out on that hamster wheel, and instead get a vehicle and get a vehicle that can take you into the future, you and your investors into the future. So start small. You don't have to do a massive fund. Start small, but put together a vehicle that works for both you and your investors, is sustainable, and can grow. What about out-of-country investors? Out-of-country investors are welcome to invest in your fund. The difference with out-of-country investors, though, is that they do have to go through a process of, making sure that they're not coming from a terrorist country, or, their money's coming from some place that it shouldn't be coming from. But more importantly, with out-of-country investors is taxes. If you have investors who don't have a tax identification number or an employee identification number or some kind of social security number, something that identifies them with the IRS, and they're from any country other than Canada, which we have a tax treaty with, which is not for this webinar, but if they're from any other country other than Canada, then what you are required to do is have a 35% withholding with those foreign investors. What we typically do if a client of ours has a lot of foreign investors and also a lot of American investors will set up a main American company that where the American investors will go and they'll invest. And then we'll set up what we call a blocker entity. And the blocker entity has different tax ramifications associated with it. And the different tax ramifications that are associated with it will then protect not just the American investors from the foreign investors, but will protect the foreign investors from the 35% withholding. So we set up that blocker entity. The blocker entity invests in the main entity. All the foreign investors invest in the blocker entity. Again, a very, I don't want to say it's complicated, but it's beyond the scope of the topic of this webinar. So I'm gonna move on right now. And Taro asks, have you ever done an EB5 investors funding for an investment project? Yes, I will tell you this though. EB5 investment money, to get that all approved and worked out, it takes like, and it might even take longer now, but it was taking like 18 to 24 months to get finalized and approved and set up. There's a lot of problems with EB5 investor money. There's been a lot of scams. So there's just a lot of issues with that, but can it be set up? Absolutely. If you need help with that, you're welcome to email me. I'll probably refer you to somebody else, quite frankly, who's more well-versed with EB5 investors and going through that process, because it's not just a securities issue, it's also an immigration issue, because EB5 is a visa for those of you that don't know. And basically what these foreign investors are doing is investing money for the purposes of getting not just an investment opportunity, but mostly for the purposes of getting a particular type of visa. So there's a lot of laws involved there. And the project itself has to have a lot of things attached to it as well. So can you get EB5 investors for an investment project? And the answer is it depends. Again, outside of the scope of this particular webinar. What is the difference between a pool and a syndication? What are the pros and cons for each structure? A pool, I guess really the question would better be asked, what's the difference between a fund and a syndication? Because a pool of investors can still invest in a syndication and normally do. But what a fund implies is that there's more than one property that may or may not specifically be identified. And a syndication is literally one property. And it's not limited to just real estate. You can actually syndicate almost any asset. So for example, I've syndicated funds before. I'm trying to think of what else I've syndicated besides real estate and funds. I know real estate and films rather. I know there's something else I've syndicated before, but you can, horses. I've syndicated horses before. So you can syndicate almost any asset. And so when we're talking about a syndication, we're talking about a specific asset as opposed to a fund where we're talking about several different assets or several different opportunities which within each one. And what are the pros and cons for each structure? Well, the pro for a syndication is that you have this specific asset, you can sell the specific asset, you can say to your investors, this is the asset you're investing in, and that's the sales pitch. It makes it a little easier for you. Also, you're very narrowly focused and everybody's on the same page. When you get into a fund, however, the pros with that are that you can identify a variety of different projects and you can also offer diversification to your investors. The list of what I need to do. Once we know what we want to do, how long does it take from start to finish? Kimberly, that's an excellent question. And what we tell people is it really takes about 2 to 4 weeks from start to finish. Once you come to us and say, hey, this is what I'd like to do, can you put it together? And I will tell you right now, there's a lot of services out there, whether they're attorneys or otherwise. I've seen this in recent history, who promise documents very quickly. And truth be told, we can get your documents done very quickly. And I'm going to tell you right now, you don't want us to. There is a process to this. And part of that process is you understanding exactly not only what we're providing to you and what you're getting and what you're looking at and what you're offering your investors, but also what you want. And we find that even the most confident, well thought out clients of ours often second guess themselves, and with good reason. They're taking in investors' money. They have to make sure those numbers work. They have to make sure the property works. So you really want it to take 2 to 4 weeks. You really want that to happen because you want to be able to have time to think, to plan, to have a trial period, if you will, in terms of reading your documents, understanding what's in them, and understanding what you're selling to the investor. So to scale this type of fund, how many worker bees do you need to support all of the lending vehicles? For example, you may need to get 2 to 3 people to deal with custodians. I have personal experience with this, and the company ended up setting up a portal for our investors to log into and get the docs when needed. What do you recommend? Paula, that's an excellent question. And honestly, I really should probably be doing some interviews with some of my service providers. I have a couple of service providers that I use for this very purpose that I recommend to clients. One of them is Investor Management Services, IMS. So you can check them out. Excellent service provider. And then the other one that I use on a very regular basis is Redwood. Real estate administration, I believe. It's redwoodrea.com. And they're excellent as well. I have not had a bad experience with either of those companies, and I don't recommend one over the other. I recommend them both equally. I have found that for my clients, it's really about what their preference is. So you really want to check both of them out to see what's better for you. So I hope that helps. How is offering investors different incentives, for example, different investor returns, different than your introduction of having multiple investors offering different terms in the PML scenario? Because that's a great question, Robert. So if I have a property and I say to you, Robert, hey, I have this property and you can invest, then you as the investor almost invariably feel, because it's A to B transaction, that you can negotiate with me, and rightfully so. However, if I present you with these documents where the terms and conditions are already laid out and you have to choose based on those terms and conditions, there is no room for negotiation. I'm making you the offer and that's it. The other thing is too, if you invest today on September 1st in terms of a property, then that clock starts ticking then, and your deal ends when your deal ends, and then I owe you that money. As opposed to a fund, if you invest on September 1st, you're going to get paid the same time all the other investors get paid. Now, your distribution might be different based on when you invested, because time does affect distributions. However, we are not putting ourselves in a place of negotiation when we're offering, hey, if you invest more money, you're going to get a higher return. We're just saying we have separate classes for those investors who invest more capital. And you're taking out the ability for the investor to negotiate, because you're saying there is no negotiation. This is how I'm treating everybody. I'm going through some of these questions because, frankly, there's a lot. Give me 1 second. Okay, Dan asks, how difficult is it to change the size of the fund? For example, what if I create $1 million fund and then want to expand it to a $2 million fund? Easy. You write right in the document saying, hey, I am going to we are going to raise $1 million, but we may expand this at a later date to up to $2 million. It's really that simple. On average, what is the minimum cost to set up a fund? Generally speaking, we say that the cost is about anywhere from $10,000 to $20,000, depending on how much money you were looking to raise. So that's really what you want to be looking for. Steve asks, how much more does it cost to start a $10 million fund than a $1 million fund? And it's about $10,000. Hopefully that answers your question, Steve. And so everybody asks, like, isn't it the same paperwork? And the answer is, yeah, it is. It is the exact same paperwork. I'm not going to lie to you. But there's two things at hand. When you're doing a $10 million fund, it's more money, more problems, right? And what I mean by that in this sense is that generally speaking, we have to be more mindful of the different scenarios that can come up in a $10 million fund. And it just takes more time. It's just the nature of the beast. The other part of it is, our insurance goes up. So you may or may not have noticed, for our level of experience in what we do, we are very inexpensive. We're not cheap, but we are very inexpensive. We are very affordable to the first time, second time experienced syndicator or fund starter, fund creator, fund something, fund runner, fund manager. Ah, there we go. Fund manager. So we're very affordable in that regard. With that being said, the more money you go to raise, the more it costs us in insurance. So we literally, whatever you go out to raise, not what you actually raise, what you go out to raise, what your fund is for, we have to report that to our insurance company, and our premiums go up based on that number. So that's one of the reasons I always encourage people to do smaller funds at first, because one, it is going to optically be better for the investor if they raise all of that money, number one. And number two, it is going to cost them less in legal fees. And there's a third reason to this that I always explain, especially for the first time fund manager, is that it's like the first time I was buying a home. I was buying a house, and I worked in real estate at the time. And I remember my boss at the real estate investment firm said to me, because I said something about the house, like, oh, it's not my dream home, but it's a first time home, et cetera, et cetera. And he said, you never want to buy your dream home on your first house purchase. And the reason is because you are going to discover things about that house that you don't like after you move into the house. Like, there's no way of knowing what you don't like about the house until you move into the house. For example, and the example he gave was, you might find that you wish there was an outlet in a certain location and it's not there. So in your next house, you'll know to look for that. And it's the same with creating a fund. You might do your first fund and realize, oh, I wish I charged a refinance fee, or I wish I had a fee for construction management, or I wish I had a fee for this, or I wish I did the distributions this way instead. So that's why I always say start out with a smaller fund when you first do a fund, because you might find things you want to change. So those are the three reasons why you want to do it that way. Let's see. So Steve asked about filing U2s. You know what, that keeps changing, because the more states that are going online are not requiring the U2 anymore, because you're filing electronically and they don't require the U2 when you file electronically. So Steve, to be perfectly honest, I don't know right now. A couple of years ago, I probably could have told you, but right now that is a moving target. So I don't know the answer to that. Can you give a deeper explanation on tying to an index? How would that look, or give an example? Thanks. Yeah, so Richard, so for example, I saw a deal the other day that said our preferred rate of return is going to be LIBOR plus 3%. That's how you would tie to an index. I don't necessarily recommend that, by the way. That's one way of doing it. I don't particularly care for it. So just, and you usually don't see those in smaller funds. You see them in big funds. So this is a closed-ended fund with a limited time to enter. That's up to you, but I would say yes. And again, that goes back to the last point I made about the three different reasons as to why you want to have a smaller fund. And number three being, you might find things later on that you don't particularly care for, or you wish you didn't do. You also want to have a closed-ended fund so people can't just think that they can get in it at any time, that you'll always be there for them, kind of thing. Limited opportunities are always better than open-ended opportunities. All right. There's a lot of questions here. And unfortunately, I have got to go, as I'm sure half of you have to go too. As a matter of fact, let me see here. Yeah, we started off like 150 people. We're down to 95. People are tiring out. We don't want people getting tired. There's no getting tired in private money. So a couple of you are asking about Private Money Rockstar. Just go to privatemoneyrockstar.com. You pay there. It will automatically send you email on how to get into the program. And then I will be sending you emails fast and furiously this afternoon on how to get into the Facebook page, as well as on how to get into the class tonight. Guys, I want to thank you so much for coming out today. I know you still have questions, and I really, really, really want to answer more of your questions and help you out, but I can't do it right now. We'll save these questions. I'll get this out to you, I promise. Thank you all again. I'll see you next time, and have a great rest of your day. And go to privatemoneyrockstar.com, sign up so you can join us for coaching tonight. Goodbye.